Welcome back, traders and investors. We have Father Emmanuel on the line, and he has been active as a short seller, also as a long player in a couple different stocks, and we're going to talk about them today. How you doing, Father?
Good, thank you, Joel. How are you?
We're doing good. Okay, first we got to talk about your Nova fund, and you like to play both sides of the market. Would you say that your splendid returns, you profited more from the long side or the short side, or is it about equal?
Well, the Umbrella Fund's done very well on the short side, but definitely we've made far more on the long side. It's a long bias fund, and in a perfect world, we'd probably be long all the time. But in a stubborn market that keeps rising, I think any manager has to look at the short side as well. And thank God those have done well, those positions.
Okay, what's the basis of your value models, and did you create them on your own?
Well, going back to 2010, I picked up a copy of Ben Graham's The Intelligent Investor, and I really just committed it to memory, and it did the same thing with security analysis. Going through and in those early days and further dissecting financial statements and rebuilding them, I did some of that in Excel and so forth. Just really looking at the anatomy of these, various and sundry income statements and statement of cash flows. But after some time, it really just stopped doing that. It's really just done in my head, to tell you the truth, all the time. I mean, very quickly you can look at a company and usually you can figure out in 30 seconds if it's worth exploring further. And you can do pretty well just by knowing what not to look into and what to avoid. So there's no real models or anything like that or formula.
Really?
Each commitment's unique.
You
Sure,
don't have any
absolutely.
fancy computers out there you're putting all this data into, or
No,
consultants that you're leaning on. You're not
uh,
out there crunching the numbers every day and getting your
uh,
readouts. You're just doing it the
no,
old-fashioned way.
yeah, yeah. I don't have a Bloomberg terminal. I had a pretty dysfunctional computer up until recently, and it's pretty old school, to tell you the truth. I mean, I love technology as much as anyone else, and it has an important role to play. I don't want to downplay it, but it just happens to turn out that way. I think really good investing decisions, they come to us in the silence. I mean, that's where we get onto something that I feel might be overlooking, and a moment of quiet reflection after absorbing a lot of information.
Okay. With such spectacular gains over the last 2 years, have you been getting more assets to manage?
Oh, sure. Our assets under management have grown about sevenfold in the last 24 months, and we have just an enormous amount of interest in the fund. I'm sure there's more than 100 investors who have expressed interest recently, and it looks like in the next 24 months, for example, perhaps we could get to 400 or 500 million or something like that. So I mean, the fund started very, very small, only about 2.7 million
Really?
when we launched, and
Wow.
it's really grown very quickly. Sure.
Did you
Well,
start with any of your own money?
well, I personally don't own anything. I have a pretty simple life. I don't own a car or anything like that, or
You don't own a
uh,
car?
very basic material possessions. But the Lemelson family, I've done my best to actively try to get them involved, and they do constitute a fairly large percentage of the fund.
Okay.
Uh,
Are
so
you
this is that their interests should be aligned. I think it's hugely important. When I hear a fund manager who has very small stakes in a fund, I wonder why that is. Oftentimes, I wonder if that's because the strategy you employ with other people's money is different than you with your own or the people you love. But the Lemelson family accounts for about 39% of the fund or something like that. It's a very large percentage.
That's interesting. Are you afraid that you're getting these new clients that are coming in that their expectations may be based too high in your last 2 years of performance?
Absolutely. It's on my mind all the time, and every opportunity I get to speak with investors or write anything, I'm constantly reminding them that it's not possible to not have down quarters or even down years. Maybe if you were a trader, somehow you could escape that, but if you're really an investor, you can get a pretty good approximate sense of the value of an asset, but you never know when the market's going to agree on timing. And so, if anything, I mean, a lot of these ideas wind up being, every investor really wants to believe he's going to have a eureka moment, and the next day the market's going to figure it out after he places his commitment. But usually it takes much longer for the market to come around to any form of agreement on that. So it's just not possible to have up quarters and up years every year. And I do worry a great deal. I tell my investors all the time, look, don't expect these returns in the future. And jokingly, they say, well, Father, we do expect them, but so there's certainly a risk there. Absolutely.
Okay, so you've had a pretty benign market over the last. You started your fund in 2010, correct? Or 2012?
Well, no,
2012.
I started managing money in 2010.
Oh, okay.
And I did that totally purely on a really volunteer basis. I mean, for almost 3 years, I managed money informally. I was offered pay and so forth. I didn't accept that, and I mostly just wrote articles. I mean, the idea was teaching and to publish articles that were in some way didactic. And those things really spread and took on a little bit further reach than I thought they would have. And then really investors by 2012, we really need to start a fund. And we wanted to start this fund and eventually acquiesced. That was September 2012.
Okay. Do you think that you'll be able to produce, bang up returns like this if we go into a full-fledged bear market?
Well, that is really a great question, Joel. And in our annual reports, we point out constantly that the Emmanuel Fund has only existed in the rising market, and that's noteworthy. It has a short track record. We can't overlook that. But we're going into our third year now, so we can't really say it's totally a new fund. And then, a lot of our gains really have been from short sales in a rising market. So
that's amazing. That's amazing.
That. So, I mean, if you were, getting large gains on short sales in a declining market, you'd say this is really following, the indexes or something like that. But when you're getting large gains from short sales in a rising market, maybe there's some ability there. I mean, it might not just be, coincidence or something like that, if there is such a thing as coincidence.
Okay, so let's get to some of your holdings here. Let's start with WWE. I did that article a few weeks ago, and believe me, I know how hard it is to get on one side of a winning trade, but to get on both sides of a trade, that's a whole nother story. You picked a short position in this thing based on your metrics. The bottom fell out, and I mean, you talk about market timing. I mean, you turned around on the day that it made the exact low. You reversed your position, which is very, very difficult to do from a short to a long, and now you're riding the long up here and back over $15. How you feeling about that position now on the long side?
Well, glory be to God, as I always say. We asked that our work would be blessed, and that morning when WWE really tanked, it's interesting because when you're selling short, I think you tend to maybe be a little bit more careful in analyzing the companies, and you're really scrutinizing it because short sellers have unlimited liability, unlike longs. And I think people, as unpopular as short sellers are, they're usually providing analysis that is a little bit more thorough than the longs, and so you're really getting to know a company when you're shorting them. And when you look at the WWE franchise, you see a great business, been around for a very long time. I mean, I can certainly remember as a young man, the years when we were living in the U.S., having a real affinity for Hulk Hogan and Andre the Giant, and these were like benevolent, role models almost. And it's been around for a very long time, the business. And you look at it and you say, well, this is not going to go anywhere because there's no replacement, there's no real competitors. You go into a Toys R Us or something, you see an entire aisle dedicated to WWE branded products. And it's just, but not at any price. I mean, at 31, it didn't make sense. But once you get to know the business and you see what they're doing, when it was in that $10 range, we said really it was going to be in that range, and we said it's worth between like approximately $9 and $11 a share. We looked at it that morning, and we took the long position. We said, well, this is what we said it was worth at the time, and if there were to be any changes in the model, then this stock price would appreciate, and they did make changes. And we called for changes. They didn't make exactly the changes we wanted, but they did cut their stack by 7%. We had told SNL Kagan, the media outlet, that we didn't think they'd meet their OTT subscriber numbers, but that didn't mean the business didn't have value. And sure enough, only a few months later, they were saying they were going to need more time, they were going to need more subscribers to break even. And of course, the original short thesis also pointed that out. That they probably were not going to meet their OTT subscriber numbers, but I think it's a perfect example of the market overreacting on both sides.
Do you remember Dick the Bruiser?
No, I don't. Sorry.
Yeah, that was he was a local favorite, or the Sheik. How about the Sheik?
Yeah, it sounds familiar. I do remember him actually. Yes, he would come out with his all his garb on. Sure.
Okay. All right, let's talk about a couple of other of your holdings here. You've been nailing
Sure.
on the short side here, Ligand Pharmaceutical. You sticking with your short thesis on this issue?
Yes. Yeah, I believe they're trading around 50 now, so they're still down about 30% from when we first shorted them. It's just been a couple months. I think there's more downside there for sure. I don't know. I mean, maybe in a raging bull market, and you have this sort of sub bubble and biopharma, and as Janet Yellen was quick to point out, just a few weeks after we released our comments, but that sentiment will change. I think the party's already over, and people don't know it yet. I mean, they may not have pulled out a lot of money, but certainly Ligand's largest shareholder, BVF, did. I mean, they've been dumping the stock, and markets when they're at their best. I mean, they're really a mechanism to gather capital around enterprises that will be good for our economy and maybe the advancement of our society. But at their worst, they become a wealth transfer mechanism. So when you see an example like Ligand, it's hard not to see it that way. You really see sort of early investors, part of a hype machine. They're in there as they're building this price up. They're gradually transferring their shares really to perhaps less sophisticated investors. And you see it, again, when the markets are not working the way they should be at their worst, that's what's going on. And executive compensation, of course, reflects the success of that activity. You have a company with $7 million in net earnings or something like that in the last 12 months. The CEO is paying himself, 50% of that amount. You have to wonder, is he really thinking clearly about his fiduciary responsibilities to his shareholders, and why are these large shareholders pulling out? They know usually a lot more than your average Joe at home with a Scottrade account.
Okay. So. And you got a couple longs here. Kulick and Sophia Industries. This one is part of your long portfolio. How's that working out for you?
Well, it's just been great. Kulick and Sophia is a fantastic company. We wrote a letter to the CEO, Bruno Gilmark, back in April, urging a share repurchase program. We took a very large stake in the company. We released that letter publicly. The shares appreciated about 10% within a few minutes. And just recently, I believe it was August 27th, after that exchange, the company announced they would, in fact, be initiating share repurchase program, which is what we called for. We called for a little bit of a larger share repurchase, being up to $100 million. But, you'd be hard-pressed to find a company with more potential and more value than Kulick and Sofa. The management team has done a great job operationally. They've really turned the company around. They have a very bright future in flip chip packaging technology. It seems very clear they're going to be a leader in that area, sitting on an enormous amount of cash. There's probably a few places you could put your money that would be safer and have greater potential than Kulick and Sofa. So that's a commitment for a long time for us.
That's pretty strong words there. Okay, and now I'm dying to ask you about Apple. I know you also have a holding in that. Holy mackerel, quite some Do you watch quotes intraday, or do you just like pull things up at the end of the day? How before we go to Apple, how closely do you watch the markets intraday?
Well, not too closely, to tell you the truth. There's a big difference between trading and investing, and there's a big difference between, investing and speculation. Price movements in small segments of time are not too productive most of the time. And the Apple commitment was a very large commitment for us. We made it between March and July of last year, 2013, when Apple was trading around $400 a share. I mean, you couldn't find any positive news on the company. I mean, if you were reading the news, you would think that everyone would be owning a Samsung Galaxy phone, and nobody would own an Apple product in 12 months' time, and we didn't agree with that at all. So we have a fairly large commitment in Apple. It's something $20 million or something like that. And we bought it very, very aggressively. With dividends, we've returned something like 70% in that time, a little over a year, which is unusual. I mean, because you're talking about one of the world's largest companies by market cap. And you would think with the coverage it has on the sell-side analysts and buy-side analysts and the market at large, amateur analysts, how could you have such a huge error in price value and disparity between the price and the value? But it just goes to show you the markets can be very inefficient. But Apple's an extraordinary company. I mean, it's just, you'd be hard-pressed to find a company that's better run. And you just look at their sales figures. I mean, 4 million phones in their first day of their pre-orders. I wouldn't be surprised if their first weekend was 12 million units sold of the iPhone 6 and 6 Plus. You're talking about doubling what the iPhone 5 did in its first weekend. So, for pre-orders, it's an extraordinary business. It's more diversified than people think. It's more of a service business than people think. Google's been very popular, but you look at the underlying businesses, and I would say Google's a more concentrated business with declining margins and so forth, and challenges far greater than those of Apple. So I don't think it's overvalued at its current price at all.
No. One more shot is wants to see if Apple stock still has your blessing here at the $100 level.
Oh, absolutely. I mean, they've got, I think, $60 billion left in their share repurchase. They've got a very healthy dividend. I mean, of course, we're collecting a larger dividend than people who are buying at 100 because we were buying it around 400.
Correct. Wow.
Well, it's the equivalent of 700 now, right? I mean, before the split. But so those dividend payments are meaningful. The share buyback is meaningful. Then it's like any technology company. It attracts a lot of speculation, and who knows what sort of things are going on, and people trying to get in and out of stock, on an intraday basis that might cause these permutations in price, 4 or 5% in a week or something. But over the long run, it looks awfully safe, and I suspect if the markets were to pull back, Apple would look even safer to most people. When you take cash into account, I mean, it's P/E ratio, especially going forward, really, really conservative. I don't know where you could find that sort of entity trading at that price multiple.
You gonna buy an iWatch?
Oh yes, oh yeah. I'm very interested in that. Certainly, we have a lot of Apple products in our home. And,
really? Okay.
Sure.
All right, Father Emmanuel, any final tips for our investors here? You play both sides of the markets. We pulled off the all-time high. Just any final words of advice for traders and investors?
Well, be conservative. It's a marathon. It's not a sprint. Nobody ever regrets being too conservative, but lots of people regret taking on excess risk. And, think about the power of compounding over the long run. You don't have to have a huge amount of capital. You don't have to have off-the-charts returns to do very well. Slow and steady wins the race, to use the sort of Aesop's fable, wisdom, if you will. And really, try to do your own work and think for yourself. There's a lot of noise out there that will lead you down 1,000 different ways to fail. But the path to success is pretty narrow, actually. It requires a lot of focus and hard work. Nothing comes easy. I mean, if you find yourself inclined to trying to get rich quick and so forth in the stock market, you probably would be better off finding a good value manager and handing your capital off to them. So knowing yourself and being honest with yourself is huge. There's not that many people who can operate in the markets without an inclination to speculation. And that doesn't usually work out very well in the long run. So that would be sort of the only advice, I think.
Okay, Father Emmanuel Lemelson, founder and president of Lantern Foundation and chief investment officer of Lemelson Capital Management, one of the top-rated hedge fund manager in the world. So glad to have you on your show. We love your insights into your individual issues as well as your wisdom on the markets and just life in general. Really enjoy having you on, and I'm sure we're going to get you on again soon.
Thank you so much, Joel. I really enjoyed being on your show. I'm humbled and grateful, as always, for the invitation. And your site's just done a phenomenal job. I mean, the service you're providing to investors, really happy to be a part of it. So thank you.
Okay. No, thank you. We'll talk to you again soon.
Take care. Bye-bye.